JBlog, 9th of January 2011. Starting out with MarketWatch. Big headline, US gets boost from retail, which is funny because when you look at the actual detail of the article, um, it talks about that there may be better economic data being published today. It's not saying that there is. It's just this is wishful thinking. It might happen, it might not happen. But I love this part about the virtuous cycle. What is virtuous about consumers spending money that they don't have? Or maybe they do have it and it comes from having defaulted on their mortgage. The bank doesn't take the loss because that looks bad, so they basically live in their as of soon to be foreclosed house for free until the bank can actually get around to it. Doesn't sound particularly virtuous to me, but whatever. Um, Going over to the S&P 500's PE ratio, we're now at 23.22. Now, we were told at the beginning of the year that the market was undervalued because all of these earnings were supposed to come out, and forward-looking, that number was supposed to be much, much lower than that, around 14, 13, 15, thereabouts. Well, it's still at 23. Nothing has changed. The year of the mythical sales that were supposed to come did not come. But the market doesn't seem to be particularly concerned about that. Here's a chart I came across just recently. It's the S&P 500 from 1900 to present. Now, of course, it didn't exist in 1900. It was derived by looking at the stocks backwards. But anyways, here we have these bull-bear phases. Starting out with a bear phase from 1906 till 1921, then from 1921 till 1929. That, of course, was the their big bubble, debt bubble. The 1921 to 1949 correction. It really took that long to wash all of that extra money out of the market. Then we had a bull market from 1949 to 65, then a bear market, which wasn't really much of a bear market. There was enormous amount of inflation in here. That's really why, even though the market did go down in inflation adjusted dollars, it just stayed flat in in real dollars. Then there was, of course, another liquidity bubble right here from 1982 until 2000, and then we have now had uh, the correction in 2000. Then we had another liquidity bubble here, and of course we had this drop here. Now this is projecting into the future um, for this market to come further down, and for this secular bear market inside its trading to continue until potentially 2015 to 2020, which sounds about right. That's basically what I believe we can expect for this market to not go anywhere in that time period, simply because all the liquidity that has been created in here has to be taken out of the system. Um, Another one I like to look at is the TED spread. TED spread is the interbank interest rates that banks charge each other. Um, Slowly rising bottoms on this one, so banks are continuing to be a little more worried about what they hold on each other's balance sheets, which they should. There's still lots of assets on banks' balance sheets that have not taken the hit that they should. Um, Another interesting chart to look at is the Baltic Dry Index, which is shipping rates, and it has, of course, been dropping substantially. The critics say that that's because there's an oversupply of shipping capacity, which could very well be the case. But on the other hand, it could very well also imply that not as many goods are being shipped, which could put a lot of the recovery and economic boom in the BRIC nations make them questionable, because if there's no goods that are being shipped, then where's this boom? Now the chart I was looking at is this is the same chart as we were looked at before. This is the S&P 500's long-term chart going back all the way until um, these numbers are not quite right. This goes all the way back. Um, let's look at the Dow Jones instead. It's the better chart to look at because it just has the longer run. This goes to the turn of the century, and it shows you that this is the very long-term run. This is while gold was still money. Then, of course, we have gold no longer being money, and we have a different path here. But even this path is um, um, the market detached itself from the trend line, and this chart can easily come back down into the 4,000 to 5,000 range until it finally touches that trend line, that long-term trend line again, which is in line with um, the gold, and one ounce of gold and one share of the Dow Jones once again meeting at a 1-to-1, 1-to-2 ratio. Gold, I believe, will eventually go at or above 3,000, and the Dow Jones will most likely come down into the 5,000, 6,000 range. It has done this several times this century, and it will probably do it again. So that's an interesting long-term chart to look at, just to show how overvalued things really are. I wrote a little piece on my blog about money management when you're a trader. You can have a look at that. What else have I been doing? Important chart to look at is the US dollar. The US dollar is once again in an uptrend here. It has not quite managed to get this uptrend, but probably I'll draw another trend line here and it'll probably manage to do that. So US dollars are going up, and of course euro and other currencies are going down. So that's a strategy I've been following for a while now. US dollars going up versus um, the euro. Oil, I was talking last week how oil got to the top of this band, and indeed it is starting to reverse here and will probably then go to the bottom of this band. So I expect oil will be in the low 80s um, coming up pretty soon, and then will probably bounce up from there again. Natural gas continues to go up. Also, I believe in natural gas simply because it's too cheap. Nobody's making money, so prices eventually have to go up from here. Gasoline is a big problem for the US consumer. A huge problem, in fact, because every time this goes up, the US consumer has less to spend. Gold is starting to get weak. It has broken the trend line, and I was pointing out a divergence, a technical divergence, um, and it has indeed now broken this top line. I expect gold will probably go down to a little bit below 1300 to be picked up by the secondary trend here, or by the primary trend really. This one was the secondary trend. Silver's done roughly the same thing. It once again has broken the trend line. What's interesting to look at here is that the gold-silver ratio that has been decreasing very steadily since September has now broken out of this channel, and that is something that I am keeping very close eye on, because it basically spells that there is something that changed. This is where QE2 came in, and QE2 drove drove this gold-silver ratio down. Now, there's a few things that can account for this. There's the possible short squeeze, silver short squeeze, but potentially it could also be an economic slowdown that is being flagged by this, because silver is, of course, an economic metal, where gold is an industrial metal, I should say, where gold is real money, the only money. So that's a change here. In euros, gold really has not changed. It has stayed pretty flat, which is why this change in gold that we see here might very well be simply a change in the US dollar right there. So from a euro perspective, gold really hasn't done anything, and silver would be the same. But the change in the gold silver ratio still stays the same, because that's of course currency independent. VIX, no fear out there. Nothing can go wrong. Investors are and traders are ignoring all kinds of risks in their minds. Nothing can go wrong. And when I'm looking through charts, I- I'm 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 puzzled, because I cannot find any bearish charts out there in any of the indexes. Things are starting to slow down a little bit. Potential negative divergence in some of the bigger indexes. One thing that is interesting is that the New York composite has shown some weakness. Of course, it was the one that violated the trend line back here and then bounced back up. That was just before December. Bounced back up, but it never made it on top of that trend line. It stayed below the trend line. So that's an interesting thing. The S&P shows no weakness whatsoever. It's continuing to go up straight. But of course, the New York composite includes small stocks as well as bigger stocks. One thing that is interesting is the OBV. On balance volume is starting to show a little bit of weakness in the S&P 500. So there is a negative divergence right here. But outside the OBV, there's really nothing that is bearish um, about this chart. But when you look to some of the smaller exchanges, let's look at where is it? The Russell 2000, which is of course 2000 small stocks. It is definitely showing a top here, potential top here, or at least a leveling out. And from a technical point of view, it is showing definitely a weakening. And there is the S&P 400 mid cap, which is showing exactly the same thing. So even though the big stocks, which of course have access to government money very easily, are still doing well, small stocks that are less likely to have access to government money and also government markets, and not so much international markets perhaps as well, are starting to show some weakness. But if we are showing, if we're looking at the bullish percentage index uh, of the S&P right now, realistically it's running at 87. I think that says 87. So 87% of S&P 500 stocks currently show as being bullish. And it really doesn't surprise me, because when you start to look at the core sectors, S&P 500 bullish. Materials are little bit weaker, but still quite, there's nothing indicating here that there's an end to this run. Energy bullish. Financials bullish. Industrials bullish. Technology bullish. It's all just bullish. Um, Consumer staples is actually one of the weakest of all the stocks, which is weird, because I mean it should be the consumer discretionaries. If consumers really don't have as much money as they used to anymore, that should be the weak one. But consumer discretionary is showing very strong indeed. Um, so there's just bullishness everywhere, which is why the VIX really is showing no fear. And of course, this kind of a one-sided trade can only last so long. But how long can it last? I never thought it would go this far. So your guess is as good as mine. That's my observations for the market this week. All the best, good luck, and make lots of money next week. Bye.